Hi, I'm Simon from Parkers, and today I'm joined with Martin Faulkner from Principal Financial Services. One of the most common questions that we're often asked is, why do mortgage rates fluctuate so much depending on the type of mortgage that you've got?
Yes, that's a really good question. It's probably one of the most important questions as well. So there are more, but the three main types of different rates are tracker rates, discount rates and fixed rates.
Yeah.
So we'll start with tracker rates. So tracker rates, as the name suggests, track the Bank of England base rate. Okay. So generally speaking, the Bank of England will meet every quarter and they'll decide whether base rates maybe going to stay the same, go up or go down. They tend to, if they do move, they tend to move by quarter of a percent, although, you know, there have been times when it's moved by more, but
Yep.
tend to be quarter of a percent. So your tracker rate will have a discount or an addition to whatever base rate is.
Right.
And then when base rate moves, pretty much immediately your base rate will change, depending on what
And
base
it will
rate
only
does.
change when the base rate changes? Right?
Only when the base rate changes, absolutely. So the other type of rate that we have are discounts. Now, for the most part, trackers have replaced discounts, although you do still get some discount products. And where discounts are slightly different is, again, you've got a differential based on the lender's SVR, and that's standard variable rate. So where this is different than base rate is the standard variable is actually set by the lender themselves.
Yep.
So if base rate changes, the lender doesn't necessarily change their standard variable rate. Okay, so your rate may not change immediately. So I think a lot of lenders have moved across to base rate because it is a bit more transparent and easier for customers to understand. And then the third type of rate that we've got are fixed rates. So as the name suggests, they're fixed for a set period of time. So it can be 2 years, 3 years, 5 years, you might get 7 years, you might get 10 years. The most common tend to be sort of 2, 3, 5, and then maybe sort of 10 years.
I didn't know they'd done a 3-year as well. So
absolutely, yeah. There's a lot of choice out there for customers.
So another quite common question that a lot of people will have is, so when the Bank of England drop their base rates, more often than not, lenders have already changed their rates accordingly. Why is that?
Yeah, so this applies mainly to sort of fixed rates.
Yeah.
So what actually happens is lenders borrow fixed money from the money markets based on what's called swap rates. Okay. So fixed rates are in effect a kind of predictor of what the markets and the lenders think that base rate is going to do in the future. Okay, and at a very simple level, the way that it works is that the lender has to kind of do two things when they price up a product. They need to make it low enough so that it's attractive to you and I, so that we want to borrow that rate. But at the same time, they need to make some margin on it. So it's quite a fine line that they need to tread when they're pricing up the products. So let's take a 5-year fixer as an example. To actually achieve that, they almost need to price in what they think the rate will do over 5 years, so that they can make sure that A, they can make it attractive, but B, they can make the margin that they need to. So yeah, in effect, a fixed rate is, you know, a kind of predictor of what the markets and the lenders think that base rate might do in the future.
Gotcha, okay. So when the Bank of England do, say, a 0.25% drop in their base rate, how would that normally affect the different types of mortgages that we've spoken about?
Yeah, so again, going back to when we discussed the different types of rates, so a tracker would change immediately.
Yeah, by 0.25%.
Exactly, exactly. If you've got a discount rate, then it's beholden to the lender when they change their kind of SVR. So you tend to find that there might be a bit of a lag before they do that. And if you're looking at a fixed rate, actually what you find with fixed rates, again, if we go back to the last question and the fact that fixed rates are the market's prediction of, you know, where they think base rate will be. Quite often what you will find is that actually any base rate change is already priced in. You know, when the Bank of England announce what a rate change is going to be, they tend to kind of signpost it to the market. You tend to see things in the media and in the news, so they don't like to shock the market in any way. So yeah, a lot of the time it's already kind of priced in. So it's absolutely worth people just keeping an eye on the news and just keeping up to speed with the sort of commentary that the Bank of England make.
So I guess whether you're looking at buying or remortgaging, it's really important to engage with quite a proactive mortgage broker that can monitor these rates just in case they do fluctuate during the process, whether you are remortgaging or buying a property.
Yeah, 100% right. So rates are changing all the time. So we at Principal, myself and Charlie who supports me, we're keeping an eye on what rates are doing all the time. You know, if you're remortgaging, for example, or looking to switch rate, we can look at those options for you. You know, if you're purchasing and we've applied with a lender, we will be monitoring that lender's rate. So if those rates drop, for instance, then we will move you onto the lower rate.
Yeah.